Hello, everybody. Ivan Acosta with Leader One Financial. We're going to talk about the Home Buyer Seminar 101, and we're going to give you the process, the idea of the process. Who the parties are that you need to contact with. Where do you start? How do the transaction gets through? Anyway, we're trying to give you as much information as we can. If you have any questions after the seminar, you have our contact information. You can call us anytime and we can help you with that. So let's get rolling. So where do you begin? What is the process start? So who are the people that you're going to work with and what each one of them do? It is important to know this if it's the first time you want to buy a home. And so these are the guidelines. So when do we meet with a lender? How much money are we going to need? How much money, when are we going to need it? When is it available? What kind of funds we can use and what kind of funds we cannot? We're going to answer all the questions. And then how do we find a home? What are different types of home? And who do we talk to about that to let them know what we're looking for? And so what is the process? How long does it take? All of this is going to cover. So let's get started with this. So who are the players? Who are the professionals who are going to help you buy your home? So the first thing, actually, believe it or not, you got to talk to your loan officer, because your loan officer, the first thing they do is they're going to approve you for the financing. So you got to know, first of all, if you can qualify for a home, and second of all, how much can you qualify for? What are your monthly payments? A lot of times, they say you qualify for a number of an amount, but you really don't want to spend that much money. So the loan officer is the one that's going to give you that idea. It's going to let you know, okay, this is how much you qualify for. It's like going into Walmart and without checking your wallet how much money you have. You got to have how much you qualify for. So the loan officer is going to pre-approve for the financing of your home. It's going to determine what kind of program you qualify for, and they're going to lock the interest rates. So depending on the kind of program that you qualify for, that's who's and your credit, that's what's going to determine the interest rate. And your loan officer is going to give you all that information and give you all the different options. And then also they're going to manage the loan approval process. So now once you know how much you qualify for and what kind of properties you want, then in the loan amount and the interest rate and the payments, then you're going to talk to your real estate agent. So the real estate agent is going to help you find our home. They want to write and negotiate the sales contract, and they want to manage the home inspection and the home process. So there's two processes that go at the same time. It is the loan process and the purchase transaction process. So the loan officer takes care of the loan process, and the realtor the transaction process. So you need to work with them, and the two of them work together to get you to the closing day, which is what we want. So who else is involved? Obviously, the lender, the loan officer works for a lender. And so once you get under contract, that lender is going to order the appraisal. They want to process the loan. They're going to approve the loan, and they want to provide a loan document, that loan document for the day of closing, which is when you sign all the documents, and then when the whole transaction gets done. So your escrow officer or title company, they're like Switzerland, because they are neutral. They are the ones that all the money gets sent to the lender. Actually wires the money for the loan to the title company, and they hold all the funds. I'm sorry, and they follow the directions. They follow directions from the purchase contract, and they follow directions from the lender, and they need to make sure that everybody gets all the funds that they needed. If the seller has a mortgage on their loan, that mortgage needs to get paid off, because you want a clear title. And so your lender will have a mortgage or a lien on your new home, and the title company takes care of all that. They make sure that your name is going to be on title, and they want to make sure that the sellers are no longer on title. So they get instructions from everybody, and they make sure that everything gets done proper way, and they record it with the kind of record, so everything is legal and available. So something else is a home inspector. So the home inspector, they do an inspection of the home to determine any issues. They determine there's any structural issues, any roof, plumbing, electrical, water heater, furnace, septic, wells, fireplace, HVAC, water quality, etc. It depends, depend on the type of property. Some of them don't apply, but so an inspection, is really not a requirement. is optional, but it's highly, highly recommended, especially for the big things, because the last things that you want to do is purchase a home and not do an inspection, and then once you move in, find out that there is plumbing, electrical issues, or a furnace or water heater, and then you're going to spend a lot of money. So that's why the home inspection is highly, highly recommended. Your real estate agent can help you find a good inspector, someone they work with, and they can give you a good report. And then from that point, if there's any big issues, you can actually negotiate with the sellers for them to help you fix any issues that you want to fix. And that's another part of the your real estate agent does. They negotiate with the sellers the issues that you want to fix. Then the appraiser. The appraiser gets is another independent person. That one, the appraisal that is a that is required, and the appraisal determines what the value of the property is, and it's based on you know the condition of the property, but mostly what the recent comparable sales in the area. That's what mostly what determines what the value of the property is, and that is ordered by a lender, but it's also an independent person. And so the thing that you want to at least know is that the appraised value of the property that you're purchasing, it is at least what you're buying it for. So let's continue with this. Something else that the lender is going to do, we're going to run the credit report. In our case, we require at least a minimum of 580 score for any government loan, which is the FHA and VA loans, and a 620 credit score for conventional and a USDA, depending on your down payment. But your lender, your loan officer will explain that to you. Then we want to see what any disputed accounts that you have, any collections, any judgments, all of this, any past bankruptcy, any prior short sales or foreclosures. Anyway, all these affect whether you can qualify or not, or which type of loan you qualify for. And then of course, if for some reason you're not ready or you're not able to get qualified at this point, then your loan officer should be able to offer you a good credit repair plan if necessary. I know we work with a couple companies that we refer our clients to, and they will help you get your credit ready so you can qualify for a home, which is the final goal here. So determine your loan program, whether it is an FHA loan. FHA loans, they require a minimum of 3.5% down, and they have an upfront and a monthly mortgage insurance. And FHA loans are only for primary residents. FHA is a government loan because it's insured by the government, and that's why only 3.5% down payment is required. The next type of loan that we have is the VA loan. That's for veterans, people that served in the military. And these loans are actually zero down. There is no down payment. There is no mortgage insurance, and it's also for primary residents only. And there's all kinds of different guidelines to qualify for this. So when you're ready and you talk to your loan officer, they will explain to you how this works, what your eligibility is. Also, if you're regular military, regular Air Force, or if you were in the reserves, those guidelines change a little bit. So just talk to your loan officer about what your situation is, and they should be able to give you a guideline and give you an advice of what your best situation is. So the USDA is also zero down. It's got a small annual fee that is paid monthly, but these are area and income restrictions, and it's only for primary residents. So there is an actual website for the USDA, and what we do is we enter the address of the property, and that tells us whether the property qualifies for a USDA loan. And it usually in the rural areas outside of towns, um, these qualify. These are great loans too, but like I said, there's some more restrictions. Then you have your conventional loan. Conventional loans, they are not government insured, and they're a little more difficult to qualify for. As you remember, we mentioned that the government loans require 580 score. For conventional, you got to have a 620 score to qualify for. They have a minimum down payment of 5%, and if you don't put 20% down, you will have a third-party mortgage insurance. And but the conventional, then you can buy whether it's a home that you're going to live in, whether it is a second home like a vacation home or an investment property. Whether you want this property to be a rental, then you would do a conventional loan because it's got more flexibility on the type of property that you want to purchase. So finding your down payment. So the traditional sources obviously are your savings, 401k. You can borrow money for your 401k actually to use as down payment. You can do actually gift funds. A lot of the loan programs out there allow the funds for the down payment to be a gift from a relative or from your boss, depending what your situation is. Obviously, all of this has to be documented properly, and your loan officer will explain to you what kind of documentation is required. There are also down payment assistance programs. In Colorado, we have a couple of them. There is the ones the most that everybody does is CHAFA. That's for the whole state, and CHAFA will provide you with either a grant for the down payment, or they have a second mortgage that is a silent second that there is no payment to it. But you can use that for the down payment also to pay some of the closing costs. In El Paso County, there is a program called the El Paso Bond Turnkey, and they gift you the money, and they have their own guidelines. So obviously you have to qualify for this, but that's another option for you to obtain the down payment for the property. So how the lender sees your down payment? It's got to be sourced and it's got to be seasoned. And seasoned means if you're going to use your own funds, you got to have it in the bank for at least 2 months. And you're going to require proof either bank deposits, 2 months of bank statements. Unfortunately, cash is never an option. Banks do not like to see cash. So if you have mattress money, you better deposit it now, and then 2 months from now it's already seasoned, and then you can use it. Any large deposits that don't come from your income, your payroll, then the bank is going to request to have a source, where the money came from. And then also any large undocumented deposit, they need to be seasoned for 12 months, unless it's something that you can document. For example, if you have a vehicle that you sold and you deposit the money, but if you had a copy of the title, that was an asset of yours, then that doesn't have to be seasoned because you are documented that money. And in some cases, you can actually you can borrow money against assets to use for down payment. So anyway, we can explain all that to you if that's the case that you want to do. 401k loans, if you have enough money there, one of the reasons that you can use that money without paying any penalties if you're not in a retirement age to be able to withdraw from is to purchase a home. So, I mean, there's certain terms and conditions, and different plans have different guidelines, but most of them, they do allow you to borrow money to purchase a home to use as as a down payment. Like we mentioned, gifts, and the person who's going to gift you the money, they got to have a proof that they have the money already to give to you, and then we had to paper trail. In other words, if it's in, let's say, your parents, I want to give you the down payment, we got to have documentation that they have the money in the bank, and then the paper trail that they deposited in your account, whether they transfer it to a wire, or they transfer it bank to bank, or they gave you a check. We're gonna have to document all of that stuff. So determining your buying power. So we calculate your debt to income ratio. So we based on whatever your existing debt, and then plus the payment of the new home, all that it gets divided by your gross income. And gross income is the money that you get, your income is before you paying any taxes. So in other words, if your salary is 3,000 a month, we know that after taxes you may be getting about 2,200 your actual check, but the lender actually uses the whole 3 grand as your monthly income, and that's how we calculate the debt to income ratio. Then the purchase price. Then once we determine how much you qualify for, we got to determine what the monthly payment is. And so the monthly payment is going to consist of the principal and interest, which is going to be based on your loan amount, which is the purchase price minus the down payment, and then that amortized 30 years, and whatever the interest is. The full monthly payment, which is not only the principal and interest of the loan, but also the insurance of the home, the homeowner's insurance, the taxes of the property, if there are any mortgage insurance that you pay based on the loan the type of loan that you get and your down payment, and also if there are any HOA. So all of that is going to be part of your monthly payment, and that's how we calculate your ratio. So how the lender sees your income. So W-2, we got to have 2 years job history. And if you have any bonus or commissions, you got to have them for at least 2 years to be able to use it. Same with overtime. Income requires a 2-year history and then employing to confirm that you want to be continued. Now, again, cash, banks do not like cash, guys. Unfortunately, cash cannot be used. So if you get any cash tips, you're a server or any kind of business that you get tips, if they're cash and you don't report them on your taxes, they cannot be used as income. So for self-employed people, and they got it. You got to be in business for at least 2 years. And the way that we prove that is we got to have your two years of income tax, and then we look at your self-employment taxes, and then we see how much you net. And anytime you own at least 25% or more of any business, we got to have corporate taxes from that business. So in essence, if you report a net income on your business 30,000 1 year, and then the next year you reported 40,000. So then the lender will take the 30 and the 40, 70 divided by 24, and that's your monthly income. So a lot of people unfortunately get confused. They say, well, I'm getting like $10,000 a month in sales, but from that you got expenses, you got rent, you got employees, other expenses, whatever. And so that's why lenders use your net income, and they average for the 2 most recent years. So once all is reviewed, once your income is reviewed, want to make sure that you have the assets in the bank, your employment, your credit is within guidelines. Then if everything fits, congratulations, you are pre-approved. So with that, you can contact your real estate agent and say, I'm pre-approved and I'm ready to start looking for property. So you contact the realtor, and so you have your buyer's agent, which is the one that is going to represent you. So there's two real estate agents. Most of the time, there's two real estate agents in the transaction. One is the buyer's agent. That's the one that they represent you. And then you have the listing agent, and that agent represents the seller. So all the negotiation happens between your buyer's agent and the listing agent. And so your buyer agent, they have the key to all the properties on the market. They have the ability to search the multiple listing systems. They go online, they find all the properties that are available, and then that's how you determine. Once you tell them you want in what area, what kind of bedrooms, what kind of bathrooms, what the size, whether it's a a two-story, a ranch, then they can do all the search for you, and then they find the properties that fit your guidelines, and that's how you guys go and start looking for properties. So now once you find the property and you want to submit an offer, then the real estate agent will submit an offer. They negotiate the price, they sit down with you, and they say this is how much they're asking, this is how much you can offer. And then once you come up with a plan, then they submit the offer. At that point, the lender will submit the pre-approval letter to your realtor, so it can be submitted with the offer, with the contract. So the listing understands that you have already been pre-approved with a lender to make sure that they can, you're ready to buy. Again, it creates a game plan with the realtor. Once you have the location, the price, what kind of home you wish to buy, like I mentioned, and then you figure it out, and then you do it. So understanding what is for sale, there are properties they call REO, which is a bank owned. They're Fannie Mae, Freddie Mac, HUD, traditional banks, even VA. So these are properties that the bank actually foreclosed on. Some other folks that were unfortunate they couldn't make the payment, so they foreclosed on the property. So what they do is they have those properties and they want to sell them. So once they foreclose from the folks, they put them in the market, because the banks in Fannie Mae and Freddie and even VA, they are not in the business of owning homes. They're in the business of lending money and the business of insuring homes. So once they foreclose on the property, the first thing they want to do is get rid of them, get their money back, and then put the money, back in place so they can lend it to you again. Short sales. Short sales. These are folks that they're upside down, so they owe more on a property that is worth, and so because of that, they go to their bank and they say, "I want to sell my property. I can't afford it anymore, but it's only worth 100. It's worth 100,000, but I owe 120. If I sell it for 100,000, will you take less money? And then, I don't have to pay you the whole thing. And that's what a short sale is. Most banks, accept that. And then you have your traditional sales, anybody that just wants to sell a home because they're moving out of the area, or they buy a bigger house, or they want to buy a smaller home. They just put it in the market. Then you have your flip. You have investors out there. They have the ability to buy a home that is in distress at a good price. They purchase it, they fix it up, and then they sell it for a profit. I mean, that's their business, and that's what is called a flip. So that's another way that you can find. And of course, new home builders. Nowadays, there is a lot of home shortages, and so there are builders out there building homes, and that's another option for you. So searching for your new home, like I mentioned, the multiple service listing service, the real estate agent that is representing you, they have access to all those homes available in the multiple listing service. And so that's why they have the ability to search everything out there. They're setting up your search when you tell them what to do, and then they send you on a drip campaign, and you start getting automatic emails every time a new property that fits within your guidelines that comes in the market. Then you get that automatically, so you are up to date of any property that comes to the market right away. Of course, there are other public services like Zillow, Trulia, Realtor.com. And then, of course, it's always we said that you got to be careful with those, because a lot of those systems, they do show some of the homes are in the market, but they are not up to date. So you may go to these sites and see that a home's in the market, but it really isn't. It's already sold. And so that's why the best way, the most accurate information is through your real estate agent, through the MLS. Homepath.com, those are some Fannie Mae properties. Again, this may be updated, this may be not. So writing your contract. So once you have found that home, and then you have decided that's the home you and your wife, if you're married, decided that's home you want to buy, then you make an offer. You tell the seller, hey, I am interested in your home, and this is how much I buy it for. And whether you offer what they're asking for, that you offer more or less, whatever you and your agent, real estate agent, decide, that's what you offer. So then if your offer it gets accepted, then you are under contract. If you offer less, let's say, for example, some of the houses in the market for 250, let's say I want to offer 240, then the seller says, no, I won't sell it to you for 240, but I will sell it to you for 245. Then they send you a counter offer, and then it's up to you to accept the counter offer. And then once the counter offer gets accepted by you, then that's when you get under contract. Once you are under contract, then you are required to come up with an earnest money deposit or a good faith money. This is your way of saying to the seller, hey, I am serious about buying your home, and here's I'm going to put a deposit. And it depends on the home. Some it's going to be around 1% of the purchase price, and but that money gets applied to whatever funds you need to bring to closing, down payment, closing costs, etc. So, and the reason for this is because the seller wants to sell their home, and because once they get at the contract, they're going to take the home out of the market. It means they can't sell it anymore. So that's why they need to make sure that you are serious about purchasing this. Oh my goodness, we keep getting this. Now, there also could be contingencies, like if you have a home that you need to sell, you can say, hey, I want to buy your home. This is the price, but I need to sell my home first before I can buy your home. So that's a contingent that you can put in the contract. And then you say the closing dates. And most of the time it's about 30 days from the time your offer gets accepted. We got 30 days to purchase to do the closing. So again, you determine your offer price. What are you willing to pay within your pre-approval range, of course, and determine the terms of your offer. Are you gonna get a 30-year fix? Are you gonna get a 15-year fix? Whatever it is. What the time frame? Like I said, most of the times it's 30 days, but a lot of times, the seller may say, hey, yeah, I'll sell you the house, but because they're moving themselves maybe, or they have another home to buy, they say I can't close for 40 days. Or they may say, hey, I'm in a hurry, can you close in 25 days, whatever that situation is, that's part of the negotiation. Then we have the seller concessions. So in other words, the closing cost. And the closing cost, it varies on the price. I'm gonna say 2 to 3% of the purchase price. That's a very vague number. Your loan officer is gonna give you the estimation of the closing cost, and you can request the seller to pay for those closing costs. So you can say, hey, I'll buy you home for 250, but please pay for my closing cost. And if that seller is willing and able to get it done, they may agree to that. Or they may say, okay, I want to buy you home, but I want you to change, to put new carpet. Anyway, those are what the concessions are talking about. There are contingencies to protect yourself, and by yourself too, we're talking about your earnest money deposit. So there are several reasons or several ways that you are protected. One of them, of course, financial. If for some reason your loan does not get approved and it gets denied, then the contract gets canceled and you get your earnest money back. If once your inspector give you a report and there's several things that the house need to be fixed, and then you negotiate with the seller and they're not willing to fix what you want, then at that point you can cancel the contract and still get your deposit. If there's any issues with the title, then also that's another reason to that you can cancel the contract and still be protected. The appraisal, it wasn't there, but the appraised value is also another contingency that is built into the contract. So the clock starts ticking at that point, and everybody gets to work. You like I mentioned earlier, your loan officer gets to work on the loan processing, and your real estate agent gets on the real estate transaction. So 30 days, and saying that you got to meet with a lender because you have been pre-approved, but then you got to finalize a loan application. So they say now you have because a loan application is not considered an official loan application until we have the property address. So once you have on the contract, then you have an official loan application. Then you meet with your lender, whatever forms they ask you to sign, whatever additional documentation they require. This is the most normal documentation that is needed is a 30-day pay stubs or 2 years of taxes if you're self-employed, last 2 years W-2s, 2 months bank statements, and any bankruptcy papers, divorce decree, or anything else that may affect, the ability to repay the loan. All that has to be documented. Then you sign the application, any upfront disclosures that the lender has. Then at that point, your interest rate gets locked. So if the market is volatile and the rates start going up, at that point you lock into the rate. So appraisal and inspection. So the appraisal, it's you pay it up in the front, and it's about 550 depending on the type of loan, and the appraisal management company. So the way it works, it has to be an independent party, a third party. And so the lender works with management companies, appraisal management companies, and they submit the order to these companies, and they have appraisals on rotation. So when the order comes in, they assign the order to whoever the appraiser is online, and they are the person is going to do the appraisal. And then they obviously they need to check what the value of the property is based on current conditions and recent comparable sales. And then once they give us the appraisal report, they tell us, hey, this property is worth the 250. That's your purchase price, so you're fine. And then they say, okay, the property is valued as is, meaning whatever the condition of the property is, that's what the value represents. Or they may say, okay, your property it is worth the 250, but it's subject to once you make these repairs, then the property will be worth. So a lot of times, not a lot of times, but sometimes you or the seller will have to make some repairs to the property. They could be minor repairs, but whatever it is. If you get an appraisal based on subject to, then all the parties involved get contacted. Hey guys, we got a value here. The value is there, but there's some things that we need to fix, and then the negotiation continues. So value differentials. So if the value of the property gets what you're buying it for, or a little bit higher or higher, then we're good. Everything continues. So, but if it doesn't, if it comes below the purchase price, then there's more negotiation to be done. So the first thing that happens, the seller party gets contacted and they say, hey, I'm buying your home for 250, but your property is not worth 250, it's worth 245. Are you willing to reduce the price? And then the negotiation comes up. The seller can say yay or nay. If they say yes, I will reduce the price, then everything gets reduced and continues. If the seller says no, I think my property is worth 250. I don't care what the appraiser said. I'll sell it to you for 250. Then it gets back to you. You can either pay the difference or cancel the contract. Inspection. Be an informed consumer. Consider an insurance policy. General pay through close of escrow responsible to pay should the contract not close. Um, like I said, the main thing of the inspection, we talked about the, contact that inspector, and they're going to tell you a lot of things that are wrong with the property. But as most properties, there's always something wrong with them, but most of the stuff is minor. The things that you are most concerned about is the big things. Something you don't want to buy a home and find out that has structural issues, like it needs a new roof, needs a new furnace, and expensive stuff that the last thing you want to do is buy a home and then spend a lot of money on it. So it is an opportunity to exit the contract, and there is also a way to protect you. The processing, telling your story with papers. So the loan processing, once you submit all your paperwork to the lender and to your loan officer, it gets submitted to the processor. And that person is going to validate all the information that was put in on your loan applications. In other words, if you say you make 3,000 a month, there's got to be documentation that reflects that. But it's done through your W-2s, pay stubs, tax returns. There is income and assets. Um, I'm sorry, validation. Like I said, everything that was put in the application, how much money you make, how much money you have for down payment, it has to be documented. And of course, your credit needs to be good, and that is validated by the credit report. And then the title company will do an actual title report information. In this one, it gets submitted to you as the buyer and also to the seller. And that indicates what kind of mortgage they have, what kind of liens, who is the real owner of the property. And that's for you to know, to make sure that once you purchase a home, you got to be the only owner, and your bank needs to be the only one that has the mortgage lending. So underwriting, once the processor packages your whole loan application and income documentation and assets and the appraisal and everything, it gets submitted to the underwriter. And the underwriter is the one that issues the official approval. And the underwriter just needs to make sure that that you meet the guidelines. In other words, if it's an FHA, you have at least 3.5% down. If it's conventional, you have at least 5% down. And so the underwriter said, okay, this loan is approved. We have the following conditions, and so your processor gets the following condition. They will contact you and say, okay, we got an approval, but we got to meet this condition still. And most of the conditions at that point is, okay, you put the earnest money. I want to make sure that the earnest money came out from your account. If if the appraisal had any conditions, got to make sure that is fixed anyway. So it gives us what we call the prior to funding conditions. In other words, we cannot fund the loan until those conditions get completed. Now, if for some reason there is questions on your income, on your assets, on your credit, then the underwriter is going to suspend the file. In other words, saying, I'm suspending it. I'm not going to issue an approval until I see the following things. And they give you a list. If you can meet this and this and that, then yeah, we'll give you the approval. Then it gets back to the processor, gets back to the loan officer. Okay, let's got to figure out what we need. And then they get with you, hey, if we can meet this, then we have the loan approval. So the conditions, fill in the gaps of the loan application. So time is of the essence, the sooner the better. When you get contacted from your processor or loan officer, it is very important that you comply and to meet all the documentation and information that they want, because obviously they have to send it back to the underwriter. The underwriter needs to review everything to make sure to issue the final approval. So once you get your approval and you get conditions, whatever those conditions are, you're going to work with your loan officer and your processor to get them together. And once everything together, and it gets sent for final review for any prior to doc and prior to funding conditions. And usually the underwriter will take 24 to 48 hours to review. And if everything complies, then they look at final look at the loan application and all your documentation, and making sure that you are ready to close. So they want to make sure that you don't have any additional credit increase. All the money that you needed is ready to go, that you didn't go and buy any new cars, and you didn't acquire any new debt. Anyway, a lot of things have happened, unfortunately, and that prevents us from closing on times, or sometimes prevents us from closing at all. So once you get into we advise, highly advise, that once you get on the contract or you get pre-approved, do not change anything on your financial situation. Because once we get somebody pre-approved, they always ask me, you know, how long is this good for? Well, really, the documentation does expire, but if your situation doesn't change, in other words, if you have the same job, same credit, same income, same type of debt, then your pre-approval is really good forever, as long as nothing changes. But so that's why anytime the underwriter reviews, they do pull a final credit to make sure that you did not go ahead and buy a new car, a new TV, and then you don't qualify for the loan. So once you get the loan, I'm sorry, the loan office, I'm sorry, the underwriter issues the final approval, then the final loan docs are ordered. And then we have a closing department. They are the ones that make sure that your names, if everything matches, if there is any power of attorney used for, if there is such a thing, everything got to be the way it's supposed to be. And then all parties need to be available for signing. In other words, if it's you and your spouse, or if you have any help from any co-signers, parents, relatives, or whatever, everybody's available for signing. And if not, if they don't want to be in town, we may have to overnight paperwork and everything. So that's what the closing department does. And then they make sure that all the funds needed for closing are available in the bank and ready to be used for funding. Then a tentative signing appointment is set once all this is ready. And then most closings happen at the title company's office or the real estate or builder's office. That's where everybody gets together, buyers, sellers, and the closing documents and the real estate documents are there and everybody signs and at the closing appointment. So the final money to close your real estate transaction, the money that is used for the closing, you need to use either wire it to the title company or bring a cashier's check. It has to be certified funds. Then they're gonna need your driver's license because every document that you sign gets notarized. So that's why you gotta have your ID. The realtor and loan officer on hand to answer any additional questions to make sure that everything is the way it was promised to you. And then you sign a promissory note. A promissory note meaning you promised to pay the loan to the lender. And in a deed of trust, that's the mortgage. That's the one that says that gives the right to the lender to have a lien on your property. And then you sign your final loan application and redesign some of the disclosures. And then after it all gets signed and reviewed, congratulations, you are a homeowner. We're pretty fortunate that in Colorado, we call it a wet funding state, which means once you sign all documents and everything is reviewed, then you are the home and you get the keys and you are free to open your housewarming party and everything that you need to do. Congratulations. So 30 days later, now your home is yours. Your final loan docs get reviewed, and that prior to funding conditions are submitted to the closing department. That happens within a few minutes. Then the funds get into an escrow account. Those funds are wired to the escrow account, and then it needs to be recorded to the county. But all this happens after you close. And on record, once you close on your home, it takes about, depends on the title company, about a week, and then you can actually go to the county records and see that you are the new owner of the property. Like I said, you get the keys. That actually happens at the closing, and you're a homeowner. You're ready to go there. And then, of course, if everybody did a good job, we all want to have you as a client for life. Congratulations, you're a homeowner. If you have any questions, please don't hesitate to call us. My number is 719-661-3993. If you want to start the process, please contact us at any time. We are here to help you. And I hope you enjoy this presentation and you got some use of it. Have a fantastic day.